Good morning, everyone. Thank you very much for attending this session. Really appreciate your coming here for today's session. So, as I could read from the AI translation that Emily was talking about, a lot of themes about monetary tightening, about interest rates, and how it's impacting the economic outlook for global markets. So today's session is going to be based on, we are going to talk about the Canadian economy, the US economy. Given that I've been allocated only 20 minutes, so I'll keep it brief. We'll also talk briefly about global economy, Chinese economy, Europe, and emerging economies. And then we'll spend more time on investment implications, i.e. how and what investors can do in terms of implementing various strategies based on the economic outlook that we foresee. And then I'll be more than happy to take any questions that you may have. So starting with the Canadian economy, so we believe that Bank of Canada has reached its peak of interest rates. It's not going to raise any further, barring any unexpected spike in inflation, which has subsided a bit. There was a slight surprise in the last reading last month, and after that, Bank of Canada still decided to pause on its September 6th decision. So, in our opinion, that's because Bank of Canada sees that the effect of monetary policy on the Canadian economy is seeping in. It is having the impact, the desired impact that it was looking for. And the only challenge that Bank of Canada right now facing is still a very strong job market. While it's a mixed blessing in the sense that it is helping Bank of Canada, allowing the flexibility that it requires to maintain a tighter monetary policy, because as a central bank, the key function or a key target that Bank of Canada needs to achieve is to balance the economy in such a way that it achieves a low inflation target of 2%, but at the same time, it also needs to achieve optimal employment levels. So, and then balancing growth as a result of that. With that in mind, with interest rates at historically high levels, and it's not just high, it's also the velocity of how fast they move the interest rates over the course of last 18 months. That would not be possible without a strong labor market. The reason for that is when central banks raise interest rates, the immediate impact is that businesses start cutting jobs, and that would have a detrimental impact on the economy, and that could push the economy into a recession. The cushion that Bank of Canada, and to that extent also the US Federal Reserve, that they have right now is because of strong job market, they can keep interest rates higher for longer, and at the same time possibly achieved a soft landing into lending of the economy. So with that objective, Bank of Canada has stopped raising interest rates for now, as they said in their recent statement after September 6th rate pause, that they're going to be data dependent. But at the same time, the language in the messaging was hawkish. It was a hawkish pause. And they basically were very clear that in case inflation surprises on the higher end, they'll be willing to go back to rate hikes. Now, there's another aspect that Bank of Canada has one more challenge that the US Federal Reserve does not necessarily have right now. And that is the indebtedness of the Canadian households, and in general, the indebtedness. So Canada as a nation has the highest debt to GDP ratio within the OECD countries. And our balance sheets as average Canadians are extended. And that has been because of very high real estate prices, and we'll talk about it in a bit as well. So that because of that challenge, the capacity of Bank of Canada to keep raising interest rates is limited. Whereas on the US, and I'll come to that in a second, but in the US, our view is that the US Federal Reserve is going to raise interest rates at least between 1 to 3 times. So although they paused in the last meeting, but they're going to raise interest rates until they reach their peak. So our scenario for US interest rates is that they're going to keep the interest rates on pause for now, but eventually they will resume rate hiking, and they will peak at about between 6 to 6.25% sometime in 2024. So this is our overall scenario. So Vanguard looks at both economic and markets as a matter of uncertainty. So we never give a point estimate that we expect, let's say, a 6% GDP growth, a 5% GDP growth. We look at different scenarios. So our median expected scenario, most probable scenario, is that the Canadian economy is going to get into a recession sometime in 2024. There is also on the upside, there is like a significant probability that we may also be able to achieve soft landing, but on the downside, it may be a deep recession. So there are like 3 different scenarios that we foresee, but at the same time, majority of our forecasting scenarios are saying that we will be like going into a recession, a mild recession, sometime in 2024. Now, moving to the Canadian dollar. So we have seen that the Canadian dollar has weakened during the course of the last year, and especially over the past 3-4 months since the impact of the expectation of higher interest rates in the US was absorbed by the market. So as we know that the exchange rates between two currencies depends on a lot of factors, but the chief among them is the interest rate differential. So interest rate differential between US and Canada on an expectation, in terms of expectation in the future and both in current terms, is that US dollar interest rates are going to be higher because markets are contemplating that the US Federal Reserve is going to keep increasing interest rates. Vanguard's view is that they will probably increase between 1 to 3 times, 25 basis points each, and they will pause sometime in middle of 2024. But having said that, there's still a positive interest rate differential in favor of USD. And because of that, we see that the interest rate differential being in favor of USD has resulted into Canadian dollar being weaker. And then also, there's a factor of flight to quality that is helping US dollar against its major currency counterparts. So US dollar has strengthened against euro as well, and other developed market currencies. The reason is that because of the uncertainty, because of the geopolitical uncertainty that we have seen with Russia-Ukraine situation, more recently situation in the Middle East, with the commodity prices, more recently, apart from the last week events in Middle East, commodity prices were going down. That was also helping US dollar, and being the safe haven for investment flows, being the largest market, all of those factors have been helping US dollar more recently. And Canadian dollar, because of the high level of debt that's embedded in the economy, that is also putting pressure on the Canadian dollar in the near term. In the long term, however, we forecast that the Canadian dollar is going to strengthen as the economic and geopolitical uncertainty keeps subsiding. The events in Middle East are, in our opinion, are impacting the markets for now, but it's not going to have a long-term impact. The geopolitical situation in Russia-Ukraine case, it has essentially been priced in already in the market, And eventually, US dollar, we are talking about long term, between 5 to 10 years, US dollar is going to weaken against its major currencies. And by the benefit of that, Canadian dollar is going to strengthen. Now, on real estate. So as you can see, the top chart, the top line chart above is the Canadian household, Canadian housing prices divided by the household income. So the price versus income ratio has been consistently increasing, and it's essentially became an outlier since 2011-12, all the way up to the pre-COVID, and then after COVID-19, unprecedented monetary easing resulted into very high prices, housing prices in the key metropolises in Canada, mainly Toronto and Vancouver. So because of that, we have seen an unprecedented rise in housing prices, and that has resulted into very high debt levels for Canadians, but their income levels haven't increased as such. So we compared it to the US, for example, the green line, the dark green line, and the 25 country average across all developed countries and some of the developing countries. So across all those countries, Canada is way at the top when it comes to the housing price ratio versus the disposable income. So as a result of that, the affordability for housing has declined quite a bit in Canada, particularly in the major metropolises like Toronto and Vancouver. So the result of that is there's an increased risk that is being priced in the market. The balance sheets for Canadian households are stretched as a result, and the chances of consumer loan defaults are being priced in the credit markets as well. So all of that is pointing to a situation, is pointing to a scenario where Canadian economy may slide into a recession, but it may also help Bank of Canada decide, and as I was referring to earlier, that is essentially putting pressure on Bank of Canada to pause earlier than we had envisaged, because on one hand they have to balance they have to bring inflation down to the long-term 2% target, but at the same time they are risking massive defaults, so they don't want that. So that is a kind of flexibility that's been curtailed because of the housing market and because of the higher debt levels that Canadians have amassed over the years. So now we'll move on to the US economy. So in the US, our views, as I briefly explained, are that the US Federal Reserve does not have the same constraint that Bank of Canada has as such, because although a lot of mortgage loans were originated over the past 2 years over the past 3 years during the low interest rate environment, but the U.S. market, it's very large compared to the U.S. So the absorption of those price levels has been widespread across a large number of the U.S. residents who've amassed those mortgage loans. So on a percentage terms, the increase has not been that great. And then secondly, for the U.S. borrowers, they can fix their mortgages over 30 years. So a big majority of the U.S. borrowers have been able to fix their long-term mortgage rates for 30 years when the interest rate were still low. So the impact of high interest rates has not been as detrimental to average mortgage payers as it has been for the Canadians. So we've been hearing stories about Canadians now feeling the pinch of high interest rates, especially those who did not fix their interest rates. They were not on fixed rate mortgages and were paying variable. Yesterday I was talking to someone who told me they know someone who's now paying like about 7%, 7.5% mortgage at a variable rate. So all of that is resulting into economic hardship and difficulty for managing. And that again is having an impact on the decision-making process for Bank of Canada. So our opinion is the policy difference between Bank of Canada and Federal Reserve is this very point, i.e. Bank of Canada's flexibility in terms of bringing more tightening is being limited because of the higher debt levels, the affordability, and then also the fact that it may result into massive defaults, and that could create this problem of bringing inflation down could morph into a much bigger problem, which they would not like to have. And then also, for the other factor that Bank of Canada that curtails Bank of Canada's flexibility is Canada as a nation has been welcoming immigrants. Many of us in this room are immigrants, and essentially over the last year or so, Canada has received over 1 million new Canadians, which has been unprecedented. The increase in Canada's population, a majority of that is attributable to immigration, last year was 2.9%. So that is again an anomaly compared to the long-term trends. So developed economies, there are hardly any developed economies who have those levels of population increase per year. So, and the last time when Canada had this large number of immigrants was in 1955, when there was a Hungarian Revolution, and essentially a large number of people from Europe, they migrated to Canada. So between 1955 to today, this is again happening after almost like 60, 65 years. So all of that is resulting into the fact, as I said already, that it limits the Bank of Canada's flexibility to tighten the monetary policy or even keep interest rates higher. So our view is like, number one, Bank of Canada's tightening cycle is most likely they've reached their peak based on what I just explained, barring, of course, a scenario where there is a sudden spike in inflation and significant spike in inflation. Let's say there's a huge supply gap for energy prices that results into general high between 100 to 200 basis points increase in inflation. So that could compel Bank of Canada to go back onto raising interest rates. Barring that, we don't see that happening. So these are our forecasts for the key economic variables across US, Eurozone, UK, and China. So I'll hold this on the slide for a few seconds, just so that I can see many of you would like to take a picture. So please do that, and more than happy to answer questions on that later on. Okay, so now we'll move on to briefly discuss the Chinese economy, the European economy, and emerging markets. So in terms of China's growth, we believe that the growth target that China had set up last year, about like 7 to 8% growth, this is what we were expecting as well, has come down. Even though that they have ended the zero COVID policy, and Bank of China has instituted monetary easing, in contrast to monetary tightening globally. They've also been introducing steps to help with the credit situation in the economy. So all of that, we believe that the Chinese economy will grow anywhere between 5.5% to 6% over the next year. In Euro area, it essentially hasn't fallen into recession, which was a lot of our peers were expecting during 2023. However, the narrative of a weaker economic scenario for Europe is still not over. So we expect the inflation in the Eurozone to staying between 3 to 3.5%, on average about 3.3, 3.4% for the year. And the key problem that we had seen at the inception of 2023 related to the energy markets, and because of the supply situation with the geopolitical situation with Russia, that has subsided quite a bit, and that has helped the Eurozone in terms of bringing the inflation to the levels that we are seeing right now. The reason is that they managed that energy crisis, or morphing that problem, or morphing into an energy crisis very well by importing energy from other sources in Middle East, suppliers in the Middle East, Qatar, for example, and they now have massive storage of gas and oil reserves. So that has helped the European situation from European energy-related situation converting into a bigger crisis. So this is going to help Europe reap dividends in the medium term and maintain a good economic growth scenario going forward. On the emerging market side, so our leading economic indicators show that the emerging markets remain resilient, and traditionally emerging market economies are considered as the small cap of the global markets, of the developed markets. So because they traditionally have higher beta to inflation, and they are more sensitive to the global economic environment, to fiscal and monetary policies. But over the years, as we have seen in case of China, for example, their economic stance has changed from consumer-led economies to more service-based economies, and as a result, their beta to inflation overall has reduced, i.e. their sensitivity to inflation and other economic variables of developed economies has reduced. With higher interest rates and stronger dollar, emerging market currencies are going to face weakness over the next few years. The reason for that is a lot of debt or loans that emerging market economies that they have borrowed is in US dollars. So because of high interest rates, it is going to have a negative impact on the emerging markets. So I'll pause here to take any questions if you may have before we go on to investment implications. And maybe I can take one or two questions now before we move on to the next session. Yes.
My name is Wei. I'm from Equiton. We are the title sponsor for the whole 3-day summit.
Right.
So we are a private REIT, right? And basically we're in the alternative markets, as Emily has mentioned, which is by estimates going to be a quarter of the total investment market by 2025.
Right.
I wanted to congratulate you. I want to say kudos to you and your firm, because I personally, in my opinion, I personally agree with a lot of the views that you have shared here.
Thank you.
I do think, based on the data, housing has become very unaffordable and unsustainable in Canada, especially on the nominal level. You shared some on real levels, right?
Yeah.
And I had two questions for you. First is, your base case for the Fed's monetary policy seems aggressive for 2023. which I believe you on the slide it was between six to six and a quarter.
Yeah.
That's what another two hikes from where we are right now.
So we are expecting another between 1 to 3 hikes from this point onward. So, or 25 basis points each.
Right. And at the same time, you mentioned because of the restraints that the BOC faces, you believe the hiking cycle in Canada has come to its end.
Yeah, we believe it has peaked because of the restrictions.
Right. So my question is, what is, in your view or your firm's view, what is the realistic spread between the two countries or the two central banks' monetary policies? That's going. So the loonie is what at 1.35 something today.
Yeah.
So if the Fed keeps on hiking and we just stay where we are, do you not see that being detrimental to the loonie?
Good question. So the markets, the way they function, they essentially price in the future events immediately, and that's the efficiency of the markets. So the impact of interest rate differential, as we know, it's already showing in the forward curve or the swap curves between the two currencies. So that impact immediately affects the foreign exchange markets. So an example of that would be more recently. So the loonie, as you said, you've been looking at it, like it recently reached about 137.50 level as well. And then over the events in the Middle East over the past week or so immediately had an impact on the oil price. And Canada being one of the large producers and exporters, it would benefit from oil price increase. So the loonie strengthened by about two points, currency points, almost immediately. So the impact of interest rate differential is already taken care of. If anything, we expect it will go back to about 136.50, 137 level, and will stay there until that interest rate differential story subsides. In the long term, however, because of the secular factors that we see with the U.S. economy, eventually Federal Reserve, I'm not saying next year, I'm not saying in 2025 or maybe later, they will eventually cut, just like other central banks. So at that time, the interest rate differentials will narrow down when central banks start bringing the monetary tightening, they start bringing in monetary easing, reversing the monetary tightening. And that will bring the interest rate differential back into the place where they were initially at the equilibrium level. So this is where we see the loonie to be coming back in the range of between 125, 130 range, that it's like long term. It has got stronger, much stronger than that, but there were other factors to that. So to your question, we do see that the loonie to stay at these levels in the short run, at least in the next, let's say, 3 to 6 months. It's very difficult to forecast. Interest rates is very difficult to forecast. Foreign exchange, but given the current scenario, our calculus is that loonie is going to stay within the range that I just described.
Right. So okay, thank you for that answer. So basically, you're saying the difference between the two central banks' monetary policies has been priced into. Okay, thank you. My second question is, you mentioned, QE is coming, and your firm's base case for 2024 is a recession of some sort, mild 55%, a bad one at 20%, right? So again, I agree with that. What is your recommendation, your personal or your firm's recommendation to the investors on a short-term basis for the next 1 to 2 years, not 5 to 10 years?
Yeah.
In a recessionary environment.
Great question, and that is a great segue to the next section, which is investment implications, and I'll answer to that in the next few minutes. Emily, how are we on time? 10 more minutes? Oh yeah, that's perfect, more than enough. So, so Vanguard, first of all, to your question, we never look at the short term as an investor, and we advise the same to our clients to invest for the long term. The reason is that in the short term, there can be price anomalies. Investors can make wrong decisions based on the market prices, based on the news, based on emotions. We believe in the long term. We believe that investors should set up their long-term objectives, long-term goals, and then build up an investment plan, financial plan, in conjunction with the help of your advisor, and then stick to that plan, and then implement that plan using asset allocation, using funds that are low cost. And there's a reason why I'm saying low cost, because our research shows that the cost is one of the major components or drivers of long-term investment return for investors. So A, set long-term goals. B, set up your asset allocation, have your financial plan. C, set up your asset allocation. And then fourth one is to implement that asset allocation using low-cost funds, because cost of funds essentially takes money away from your pocket. So it takes return out of your portfolio. Now, to your other question, what investors should do. So we are still in a very high interest rate environment, and we looked at 7 different periods of high interest rates over the past 50, 60 years. And as you can see on the chart on the screen here, some of the asset classes have traditionally done well during all those episodes of high interest rates, and some have not. So the final column, which says average on the top, essentially shows that it shows So it shows that the average column on the right, that high quality value stocks, international equities, they're the ones who have outperformed. They have generated good results, and on average over the last 7 high interest rate environments. The asset classes that have not done well are low quality growth stocks in general, aggregate bonds, and high yield, and home prices, or real estate. So what this means is that in the current high interest rate environment, you should position your portfolios accordingly. Look for diversified investments across value stocks. Look for high quality stocks, high quality growth, and then position your portfolio over the long term. And these are our forecasts over the long term, over the next 10 years, across various subsectors of fixed income. So what you see here is, as I said earlier, Vanguard always prepares uncertainty, respects uncertainty in the markets and economy. And we provide our views, our long-term expectations in probabilistic scenarios. So the column in the middle that says 50th percentile is our most probable scenario, like median expectation. And that's what we publish usually for our public consumption. So Canada credit bonds are expected to generate about 5.1% as a median expectation over the next 10 years. Why 10 years? Because A, as I said, we invest for the long term, and B, it helps the clients, our advisors and their end clients, to plan for the long term. So if a client or if you have an objective that you want to send your son or your daughter in the next 10 years to the college and you're saving for that, knowing that you're going to invest in, let's say, Canadian bonds that on average, will generate about 5% return over the next 10 years, helps you plan accordingly. And as opposed to looking at the returns over the next 1 year, 2 years, and then there may be a huge change over the next few years. So we try to smooth out that short-run volatility by looking at long-term. So if you look at like pretty much any asset class, especially equities and bonds, the long-term returns are stable. If you look at it at very long-term averages. And similarly, on the rightmost column, we look at the median volatility or the expected volatility of the asset classes. So Canadian government bonds, about 3.3%, Canadian aggregate bonds, about 4%, so on and so forth. And now this is our valuation matrix across different asset classes. So on the left, you can see that for the US bond market, we see pretty much all subsectors, including emerging market sovereign debt, intermediate credit, TIPS, long-term treasuries, short-term treasuries. They're all within the fair value or undervalued. So the yellow bar on the left essentially is showing fair value, the green bar is undervalued, and the red box at the top is overvalued. So in our opinion, high yield is overvalued, the US high yield. And that is why we advise our investors to instead invest in corporate bonds, especially Canadian corporate bonds, because on a risk-adjusted basis, over the long term, we see higher returns per unit of risk or Sharpe ratio for Canadian bonds going forward over the next 10 years. Similarly, if we look at it at international level, pretty much all bond markets are within fair value or undervalued level, the chart on the right. So Canadian aggregate bonds, in our opinion, are within the fair value band, same as Australian, UK, Euro. The only outlier here is the Japanese bonds. So that we believe is still overvalued, and we would advise to stay away from that. Now coming back to the global or the overall asset allocation in terms of valuation, we see US equities are still in the overall valuation category, as you see on the chart on the left. And majority of that is being driven by the US growth, as I'll explain in a second. Global X US equities are within the fair value bands. Same goes for the Global X US aggregate bonds and US aggregate bonds. On the chart on the right side, we basically divide the US equity markets into subsectors, and we see that, again, majority of the US equity market subsectors are within the fair value band, except the US growth, which is at the cusp of becoming within the fair value band. As you can see, it's at the border of between red and yellow box. So that essentially is the reason why I believe that there are opportunities within the equity markets. And to your question, what investors should do, in the current market, our advice would be for long-term asset allocation would be to invest in bonds right now, because contrary to many people's view on the street that bonds are probably not like a good investment given the negative returns that we have seen in 2022 because of rising interest rates, our research shows that bonds are essentially like, you have to look at bonds not from just the price point of view, rather the majority of the returns in bonds are driven by the interest rate that it generates, i.e. the coupon, and the reinvestment of those. So as long as you maintain the duration of your portfolio in such a way that the duration is lower than the total investment horizon, i.e. if you have a 10-year investment horizon and you've invested in a 2-year maturity bond, So every 2 years in a rising interest rate scenario or in a high interest rate scenario, you will be repricing your bond coupon at a higher rate, and you will be riding the curve. So yeah, your question.
So I think you're saying buy a 10-year treasury bond, treasury bill bond, and just hold it to maturity. So I think what I heard and what I read is tell me if I'm wrong. Cash is king again. Cash is not trash anymore in this high interest rate environment.
Well, yeah, so 2 points here. First of all, we are not saying that you should invest in 10-year bonds. It depends on your investment horizon. If you're a very long-term investor, then probably that makes sense. But if you have, let's say, on average 15, 20-year investment horizon, then we still believe that you should invest in a duration that is lower than your total investment horizon. So if it's like 20-year horizon, yeah, 10-year may make sense. And then secondly, with such high yields that are prevailing in the bond markets right now, we may not see them next year or the year after. So the yield curve on the long end of the curve has recently shifted higher over the last couple of weeks, especially with Federal Reserve's hawkish pause and the comments that they are going to stay high for longer. So all of that has made the yield curve to go higher. And this is a time to take advantage of those high yields and lock in 5-year, 10-year, depending on your total investment horizon. To your second comment, like cash is king, well, our research shows that when Federal Reserve, 1 year before the Federal Reserve has peaked, has reached the peak of its hiking cycle, cash generates or it beats the bond returns. But exactly 1 year after the Fed reaching its peak rate, the bonds beat cash. So it's very difficult to time the market, to know exactly when Fed is going to pause and when we should enter the market and should I stay in the cash. Our view is that to invest in bonds now, if you have, let's say, X amount of money, start deploying it into bonds now, rather than wait, keep it in the cash, hoping that I can probably get a better opportunity. Because these are, like historically speaking, these are very high yields that you may not see going forward. So our advice would be to lock in those rates. The second part that I would like to say here is that because of expected high bond returns, our models are indicating for a balanced portfolio of, let's say, traditionally it used to be 60% equities, 40% bonds. On a forward-looking basis, on a time-varying basis, our models are now saying that for an investor who's looking for a balanced portfolio, should now invest more into bonds, i.e. reverse the position, 55% bonds and 45% equities. So instead of 60% equities, 40% bond, 55% bonds, 45% equities. The reason for that is we now see an opportunity for the risk that can be dialed down. And by allocating more to bonds, investors can achieve pretty much the same risk-return profile that they would have achieved by investing more into equities. And guess what? By investing more into bonds, the volatility in the portfolio or the risk can be dialed down at the same time. So yeah, that pretty much brings us to the end of the presentation. More than happy to take